Central banks worldwide have accelerated gold acquisitions at an unprecedented pace in 2025, purchasing over 634 tons through Q3 alone and continuing into Q4, while the dollar's share in global reserves has slipped to around 57% amid sustained diversification. This surge, led by emerging market institutions including Poland, Kazakhstan, and BRICS members, occurs against a backdrop of geopolitical uncertainties and U.S. fiscal strains, driving gold prices above $4,400 per ounce. Right now, this accelerated shift matters profoundly, as it erodes traditional dollar demand and elevates funding costs for major economies. The implications risk amplifying volatility in currency and commodity markets, potentially constraining monetary policy flexibility. Tension mounts as these purchases signal structural changes in reserve management, fostering a landscape where fragmented capital flows could precipitate broader instability and redefine global financial equilibria. As the global monetary landscape confronts escalating uncertainties on December 26, 2025, central banks have intensified gold acquisitions at a tempo that surpasses historical precedents, sustaining net purchases exceeding established annual norms for the fourth consecutive year while demonstrating remarkable resilience amid elevated prices that have propelled the metal to unprecedented levels above $4,400 per ounce. The World Gold Council's Gold Demand Trends Report for Q3 2025 documents net central bank additions of 220 tons in the July-September period, representing a 28% increase from the prior quarter and contributing to year-to-date totals of 634 tons through September, with subsequent October data revealing an additional 53 tons. Underscoring a persistent accumulation pattern concentrated among emerging market institutions. Leading buyers in this cycle include the National Bank of Poland, which has reaffirmed its target to elevate gold's share in reserves to 30% through ongoing additions, alongside consistent contributions from entities in Kazakhstan, Azerbaijan, and select Asian and African jurisdictions. This pace, though moderated from the record 1,082 tons in 2022 and over 1,000 tons in subsequent years, remains substantially above the pre-2022 decade average of 400 to 500 tons, reflecting a structural shift in reserve management strategies that prioritizes gold's attributes as a non-sovereign liquid store of value impervious to counterparty risks. The resilience of this buying activity despite gold's extraordinary appreciation, up over 70% year-to-date, and capping a trajectory from sub-$2,000 levels in prior cycles, highlights price-insensitive demand driven by long-term strategic imperatives rather than short-term opportunistic positioning. Central banks, absorbing approximately one-quarter of annual mine production estimated at 3,000 to 3,500 tons, create a durable structural floor beneath prices, mitigating downside volatility and supporting sustained upward momentum even as real yields in major economies remain positive. This behavior contrasts sharply with private investor flows, which exhibit greater sensitivity to opportunity costs, as evidenced by episodic ETF outflows during rate hike phases. Yet central bank accumulation provides countercyclical ballast that compresses correction depths and extends bull market durations. The World Gold Council's 2025 Central Bank Gold Reserve Survey, capturing responses from a record 73 institutions between February and May, reveals that 43% intend to increase holdings over the next 12 months, with 95% anticipating higher global official reserves overall, citing gold's performance in crises, diversification benefits, and hedging against inflation as primary rationales. Geopolitically, this ramped-up accumulation empowers non-Western institutions to fortify reserves against vulnerabilities associated with fiat currency exposures, particularly in light of precedents involving asset immobilizations under sanctions frameworks. Emerging market central banks, comprising the bulk of recent purchasers, leverage gold to enhance autonomy in an environment of fragmented financial governance, where unilateral actions can restrict access to dollar-denominated holdings. This insulation strategy gains salience amid ongoing conflicts and trade frictions that underscore the perils of concentrated counterparty risks, prompting entities in sanctioned or at-risk jurisdictions to prioritize physical assets storable domestically or in neutral vaults. The survey findings indicate a divergence in motivations, with 78% of emerging market and developing economy respondents rating gold's geopolitical diversification properties as relevant, compared to 46% in advanced economies, reflecting asymmetric exposures to systemic shocks. Such purchases not only bolster balance sheet resilience but also contribute to a multipolar reserve architecture where BRICS aligned institutions collectively hold over 6,000 tons, facilitating alternative settlement discussions that dilute reliance on traditional clearing channels. Economically, the sustained central bank demand establishes a robust structural underpinning for gold pricing, reducing available supply for jewelry, industrial, and private investment segments that collectively dominate total consumption. With mine output plateauing amid depletion challenges and recycling flows variable, central banks' absorption of substantial portions, reaching nearly 30% of net new supply in peak quarters, constrains secondary market liquidity, supporting premiums that have driven the metal's 70% rally despite elevated carrying costs. This dynamic manifests in market structures where forward curves exhibit backwardation during demand surges, signaling tight physical availability and encouraging producer hedging that further locks in upward biases. Private investor participation, through ETFs recording inflows exceeding $26 billion in Q3, amplifies this momentum, yet central bank buying provides the foundational layer insensitive to tactical retreats, as observed during brief consolidations when prices dipped below $4,000 only to rebound swiftly on renewed official interest. Market behavior surrounding these purchases reveals price-insensitive characteristics unique to official sector participants, who prioritize strategic allocation targets over yield considerations, absorbing volumes irrespective of spot levels that have rendered gold's real return profile competitive with equities in multi-year horizons. The rally's magnitude, marking the strongest annual performance since the 1970s inflationary episode, correlates with central bank activity that has doubled from pre-2022 norms, creating self-reinforcing loops where appreciation validates diversification strategies and encourages further commitments. Volatility measures, while elevated relative to fixed income, remain contained compared to cryptocurrency analogs, as central bank holdings, totaling over 36,000 tons globally, serve as a long-duration buyer of last resort, dampening sell-off intensity and extending trend longevity. Hidden risks embedded in this accelerated pace include the potential for abrupt moderation in buying if fiscal or external balances improve in key purchasers, triggering overvaluation corrections that could amplify drawdowns by 20 to 30% in speculative segments leveraged through derivatives. Such reversals, though unlikely given survey indications of continued intent, would expose private holders to sharper pricing, particularly in mining equities and junior producers reliant on elevated margins. Liquidity strains emerge in alternative reserve assets as capital reallocates toward gold, pressuring dollar-denominated holdings and contributing to yield pressures in major sovereign markets, where diminished foreign demand necessitates higher premia to clear issuance. Emerging market currencies, facing compounded depreciation amid reallocations, risk sudden stops that exacerbate debt servicing burdens in dollar-heavy portfolios, fostering volatility spillovers through trade channels and banking interlinkages. This ramped-up accumulation beyond historical norms underscores profound shifts in reserve management paradigms, where central banks' strategic hedging against macroeconomic and geopolitical frictions establishes gold as a cornerstone in multipolar configurations. The Q3 surge to 220 tons, followed by October's 53 tons led by Poland's renewed activity, illustrates momentum resilient to price barriers, as buyers prioritize long-term preservation over short-term costs. Survey responses affirming gold's crisis performance and diversification efficacy reinforce this trajectory, with domestic vaulting preferences rising to 59% from prior years, signaling intent to secure physical control amid trust erosions in custodial arrangements. The economic implications extend to supply dynamics, where central bank absorption constrains fabrication demand in jewelry-dominant markets like India and China, potentially capping consumption growth despite cultural affinities, and redirecting industrial flows toward technology applications that compete for scarce refined output. Market structures adapt through increased over-the-counter trading to accommodate official preferences for discretion, reducing transparency in spot discovery while enhancing premium capture for physical delivery. Volatility regimes, moderated by this steady demand, contrast with episodic spikes during private sector deleveraging, providing relative stability that attracts tactical inflows during risk-off episodes. Geopolitical empowerment through these purchases manifests in enhanced bargaining positions for accumulating nations, where gold's neutrality facilitates bilateral arrangements bypassing sanctioned channels, as observed in select energy trades. This autonomy diminishes vulnerabilities to extraterritorial measures, encouraging broader emulation among neutral states wary of alignment pressures. The resulting multipolar reserve distribution, with gold's valuation share ascending in portfolios, dilutes hegemonic influences derived from currency dominance, imposing indirect constraints on policy flexibility in issuer economies. Concealed vulnerabilities include systemic interdependencies where abrupt buying pauses, potentially from balance of payment strains in commodity exporters, could precipitate cascading corrections across asset classes correlated through inflation expectations. Banking systems holding gold-linked derivatives or collateralized positions face mark-to-market pressures during volatility flares, amplifying credit transmission disruptions in leveraged segments. Emerging market crises, precipitated by outflow accelerations from fiat reserves toward gold, risk sovereign contagion through impaired external positions, heightening probabilities for interventionist capital controls that distort local markets. As this phenomenon unfolds in real time, with Q4 data anticipated to affirm continued momentum, the ramp-up beyond norms illuminates a transformative phase in monetary history, where central bank strategic imperatives redefine asset hierarchies and impose structural adjustments on interconnected global systems. The resilience amid record valuations affirms gold's rescendence as a crisis hedge, while hidden risks necessitate vigilant portfolio recalibrations to navigate potential asymmetries in demand sustainability. Intelligence assessments must track purchaser compositions and vaulting trends, as these elements shape enduring equilibria in an era of contested financial sovereignty. As the architecture of global reserve management undergoes a subtle yet profound transformation on December 26, 2025, the US dollar's declining share in allocated foreign exchange reserves has emerged as a critical indicator of intensifying diversification trends. With the latest International Monetary Fund currency composition of official foreign exchange reserves data for Q3 2025 showing stabilization around 56.92%, reflecting incremental reductions amid exchange rate adjustments and deliberate portfolio reallocations. This erosion, down from levels consistently above 58% in prior years, and marking a gradual descent from peaks exceeding 70% 2 decades ago, coincides with an expansion in gold's role through sustained central bank accumulation, as evidenced by net purchases totaling 634 tons year-to-date through Q3, with additional activity in Q4 affirming momentum. The Q3 figure of 56.92%, reported in December releases, represents a slight decline from Q2 estimates around 57%, driven primarily by valuation effects from non-dollar currency appreciations rather than wholesale liquidations. Yet active shifts by reserve managers underscore a structural pivot toward neutral assets amid persistent geopolitical uncertainties and U.S. fiscal strains. This incremental decline aligns with economic logic where reserve managers, facing heightened macroeconomic volatility and sanctions-related risks, prioritize diversification to mitigate concentration vulnerabilities in dollar-denominated holdings. The IMF's revised COFER methodology implemented in Q3 2025, eliminating unallocated portions to provide a complete 100% currency composition, enhances transparency and reveals a more precise multipolar distribution, with the euro gaining ground to approximately 20.33% and other currencies, including renminbi, yen, and pound, collectively advancing. Central bank surveys, such as the World Gold Council's annual compilation, indicate that over 40% of respondents plan further increases in non-dollar assets over the coming year, citing gold's historical performance during crises and its independence from issuer credit risks as paramount considerations. This behavior manifests in subdued demand for U.S. Treasuries, where foreign holdings dipped marginally in recent months, compelling greater domestic absorption of issuance and embedding elevated term premiums in the yield curve despite Federal Reserve easing measures. Geopolitically, the dollar's eroding reserve share diminishes U.S. financial leverage in international relations, constraining the efficacy of extraterritorial measures and encouraging non-aligned entities to explore alternative settlement frameworks. The decline, though gradual, signals a reconfiguration where emerging market central banks, responsible for the bulk of recent gold acquisitions, fortify autonomy against potential asset restrictions, drawing on experiences that have highlighted fiat currency exposures in contested environments. This shift empowers BRICS configurations to advance parallel mechanisms, such as expanded local currency trade invoicing and digital platforms, reducing dollar intermediation and foe. Steering resilience in commodity flows critical to global supply chains. Market reactions to this diversification include subdued treasury appetite, with auction dynamics reflecting higher clearing yields to attract bids amid supply pressures from deficits exceeding $1.8 trillion annually. The 10-year benchmark, anchoring around 4.15% in late 2025, incorporates premia for fiscal trajectories projecting interest expenses surpassing $970 billion in fiscal year 2025, a figure that consumes nearly 19% of federal revenues and rivals major programmatic outlays. Volatility indicators, with Treasury futures options showing elevated implied measures, capture investor caution as domestic funds shoulder increased issuance volumes, straining absorption amid competing opportunities in equities and corporate credit. Underlying consequences encompass elevated U.S. borrowing costs that perpetuate fiscal drag, with net interest outlays projected to approach $1 trillion annually, crowding out investments in infrastructure and defense while amplifying transmission to household borrowing rates through mortgage channels exceeding 6.5%. Reduced seigniorage benefits, derived from global dollar demand, further constrain monetary sovereignty, as diminished recycling of surpluses into treasuries elevates structural funding premia estimated at 50 to 100 basis points over medium horizons. Concealed perils involve abrupt confidence shifts that could trigger capital outflows from dollar assets, amplifying exposures in banking systems holding trillions as collateral and potentially precipitating crises in dollar-dependent emerging economies through exacerbated currency mismatches and debt servicing strains. Emerging market borrowers, facing $2 trillion in maturing obligations amid benchmark elevations, confront heightened rollover risks, where sudden stops could deplete reserves and compel interventionist measures distorting local credit markets. These vulnerabilities, layered upon interconnected trade networks, risk synchronized depreciations that heighten inflationary pass-throughs in import-reliant jurisdictions. As diplomatic and economic channels navigate these strains without immediate resolution, the dollar's reserve share decline emphasizes the fragility of unipolar financial architectures, catalyzing broader diversification that heightens liquidity crisis probabilities in interconnected systems. Central banks' gold roll expansion, with official holdings valued at market prices contributing significantly to portfolio buffers, reinforces neutral asset preferences amid trust erosions in issuer-specific instruments. This evolving multipolarity, while gradual, imposes structural costs on growth trajectories, constraining policy space in major economies and fostering environments prone to volatility spillovers. The incremental erosion evident in Q3 data, stabilizing near 56.92%, illuminates a tipping point where valuation effects intersect with active reallocations, reshaping reserve hierarchies in real time. Intelligence imperatives demand continuous assessment of COFER revisions and purchaser motivations, as these trends coalesce to redefine monetary equilibria with enduring implications for systemic resilience. In the midst of an extraordinary reconfiguration of global commodity and reserve asset dynamics as of December 26, 2025, the gold price rally has manifested as a profound reflection of structural demand shifts, with spot prices surging over 70% year-to-date to breach $4,500 per ounce multiple times in December. Peaking at intraday highs around $4,526 before settling near $4,511 on December 26, amid thin holiday trading volumes. This performance, marking the strongest annual gain since the inflationary surges of 1979, has been propelled by relentless central bank purchases totaling hundreds of tons on a quarterly basis, with Q3 alone witnessing net additions of 220 tons, a 28% quarter-over-quarter increase, and October contributing an additional 53 tons, demonstrating demand resilience even as prices ascended to levels that historically constrained private sector participation. The rally's magnitude, translating to gains exceeding 70% from January openings around $2,640 per ounce, underscores an economic demand profile increasingly insensitive to traditional opportunity costs, where elevated real yields in major sovereign markets, such as U.S. 10-year inflation-protected securities offering positive returns, have failed to deter accumulation. Central banks, absorbing substantial portions of net new supply, have provided a foundational bid that compresses downside volatility and extends upward momentum, with year-to-date purchases through October approaching 687 tons, positioning 2025 for volumes comparable to the elevated streaks of 2022-2024 despite moderating from peak quarterly highs. This structural support derives from official sector strategies prioritizing gold's nani. Elding yet crisis-resilient attributes, as affirmed in the World Gold Council's 2025 Central Bank Gold Reserves Survey, where a majority of respondents indicated intentions to maintain or increase holdings amid macroeconomic and geopolitical headwinds. Geopolitically, the rally bolsters positioning for non-Western blocs, particularly within BRICS configurations, where collective reserves exceed 6,000 tons, enhancing influence over physical market flows and facilitating explorations of alternative reserve assets in multipolar frameworks. Institutions in emerging markets, leading the buying surge with contributions from Poland, Kazakhstan, and select Asian entities, leverage gold to fortify balance sheets against sanctions vulnerabilities and currency volatilities, insulating portfolios from issuer-specific risks inherent in fiat holdings. This empowerment manifests in heightened bargaining autonomy during international negotiations, where physical gold's neutrality supports bilateral arrangements bypassing traditional clearing channels, as observed in incremental non-dollar commodity invoicing trends. Market behavior during this rally reveals layered responses, with increased ETF inflows exceeding $26 billion in Q3 alone, reflecting private sector alignment with official trends, while futures hedging intensifies through elevated open interest in COMEX contracts and options positioning for tail risks. Volatility measures, though contained relative to equities, have risen with implied metrics in gold options climbing amid momentum-driven trading, as speculative longs accumulate yet remain tempered by physical delivery constraints. Over-the-counter flows, capturing unreported central bank transactions, have expanded, providing discrete channels that minimize spot disruptions while sustaining premium capture for allocated bullion. Hidden risks within this structural shift include supply constraints stemming from mine output plateaus, where global production hovers around 3,300 to 3,500 tons annually amid depletion challenges in mature districts and permitting delays for new projects, potentially exacerbating price spikes during demand surges. Feedback loops emerge where rapid appreciation fosters speculative excesses in leveraged segments, such as mining equities and junior explorers, vulnerable to corrections that could amplify drawdowns by 20 to 30%, impacting portfolio valuations in commodity-focused funds. These dynamics intersect with broader vulnerabilities in fiat-centric systems, where sustained official buying accelerates fragmentation, constraining growth in economies reliant on stable commodity inputs through elevated industrial costs and inflationary pass-throughs. As this shift unfolds in real time, with December trading characterized by record settlements near $4,512 amid holiday liquidity, the rally illuminates profound transitions in asset hierarchies, where central bank demands price insensitivity redefines opportunity cost paradigms. The resilience against real yield elevations, U.S. TIPS yields positive yet failing to cap advances, highlights gold's rescendence as a monetary hedge, supporting structural floors that extend bull cycles beyond historical durations. Geopolitical bolstering through BRICS reserves, valued in excess of market equivalents contributing to bloc autonomy, facilitates parallel infrastructures that dilute hegemonic clearing dependencies, imposing indirect constraints on policy transmission in issuer jurisdictions. Market adaptations, with backwardation in forward curves signaling physical tightness, encourage producer forward sales that lock in margins yet perpetuate upward biases through reduced hedging supply. Concealed perils of supply bottlenecks, with recycling flows variable and new mine developments facing capital hurdles amid ESG scrutiny, risk amplifying volatility during peak demand quarters, where central bank absorption could approach 30% of net supply. Speculative feedback evident in ETF premium expansions during rallies heightens reversal risks if sentiment shifts, impacting leveraged positions in futures markets with open interest surpassing prior peaks. This structural demand evolution, resilient to elevated valuations, highlights fiat system fragilities where official sector priorities accelerate multipolar transitions, constraining interconnected growth through commodity premia and reserve realignments. Intelligence monitoring of quarterly flows and vaulting preferences remains essential, as these elements delineate enduring trajectories in contested monetary landscapes. In the evolving landscape of global reserve management as of December 26, 2025, the acceleration of central bank gold accumulation, particularly among BRICS nations whose collective holdings now exceed 6,000 tons, is fostering multipolar reserve configurations that incrementally erode the dominance of the US dollar while empowering the development of alternative payment mechanisms resilient to external pressures. This transition, evidenced by sustained net purchases in 2025 totaling approximately 687 tons through October, with Q3 contributions of 220 tons and ongoing activity in Q4, reflects a deliberate geopolitical strategy to mitigate risks associated with concentrated exposures to fiat currencies vulnerable to sanctions or unilateral restrictions. BRICS entities, including Russia with reserves around 2,336 tons, China at approximately 2,298 tons, and India near 880 tons alongside newer additions like Brazil's incremental builds to 145 tons, collectively command significant influence over physical gold flows, supporting initiatives for non-dollar commodity settlements that have expanded intrablock trade in local currencies. This multipolar dynamic aligns with broader efforts to construct parallel financial infrastructures, such as enhanced cross-border settlement platforms and exploratory commodity-backed units, designed to reduce dependency on dollar clearing systems and insulate trade from extraterritorial measures. The acceleration in gold holdings, resilient despite prices surpassing $4,400 per ounce for much of late 2025, provides a neutral hedge that bolsters balance sheet autonomy, enabling participants to navigate contested environments without compromising liquidity or sovereignty. Geopolitically, this empowerment manifests in heightened bargaining positions during multilateral negotiations, where physical asset control facilitates bilateral arrangements that bypass traditional intermediaries, gradually diluting the structural advantages derived from dollar hegemony in global transactions. Economically, the transition elevates U.S. funding premiums through progressively subdued foreign appetite for treasuries, as evidenced by total holdings stabilizing around $9.243 trillion in October 2025, with China's position contracting to levels not seen in over a decade. This reduced external demand necessitates greater reliance on domestic absorbers to clear issuance volumes amid deficits approaching $2 trillion annually, embedding higher term premiums in the yield curve that persist around 4.15% for benchmark maturities despite monetary easing. Market caution in response includes diversified hedging strategies, with increased inflows into gold-backed instruments, ETFs recording substantial quarterly additions, and forward positioning that sustains structural support beneath commodity prices. Concealed perils within these emerging dynamics encompass fragmented liquidity channels that amplify volatility in emerging markets, where capital reallocations toward gold exacerbate currency pressures and heighten rollover risks for dollar-denominated obligations exceeding regional capacities. Banking mismatches arise from asset shifts, triggering credit constraints as institutions recalibrate collateral frameworks amid fluctuating valuations, potentially contracting lending volumes in interconnected segments. Inflationary pass-throughs from elevated commodity premiums further constrain global demand, transmitting cost impulses through supply chains reliant on stable inputs and dampening growth in import-heavy economies. This evolving multipolar order, characterized by BRICS holdings commanding a meaningful share of official gold stocks valued at market equivalents, risks precipitating crises in interconnected systems through abrupt shifts that undermine entrenched stability mechanisms. The incremental erosion of dollar-centric recycling, where non-dollar settlements proliferate in energy and metals trades, imposes fiscal drag on issuer nations, amplifying interest burdens and limiting policy maneuverability. Liquidity fragmentation in offshore funding markets, with periodic squeezes in cross-currency bases, heightens probabilities for sudden stops that cascade through sovereign and corporate borrowers. As reserve configurations tilt toward diversified baskets incorporating greater gold weights, surveys indicating sustained intent among emerging managers, the multipolar transition catalyzes broader realignments in trade architectures, elevating transaction frictions and fostering bifurcated flows that challenge multilateral coordination. Banking systems globally navigating these reallocations confront heightened duration and counterparty exposures, where tail events could initiate deleveraging spirals impacting credit provision. Emerging economies with external vulnerabilities accentuated by commodity dependence face amplified crisis thresholds as reserve preferences shift, constraining access to dollar liquidity during stress periods. The acceleration evident in 2025 purchases, moderated yet robust relative to historical averages, illuminates a transformative phase where geopolitical imperatives override yield considerations, reshaping reserve hierarchies with enduring consequences for systemic resilience. Market adaptations, including expanded over-the-counter channels for official transactions, sustain discretion while reinforcing physical premiums that extend rally longevity. Concealed vulnerabilities in supply chains, with mine output constrained and recycling variable, risk exacerbating imbalances during peak accumulation quarters. This multipolar emergence, supported by non-dollar mechanisms gaining traction in BRICS corridors, imposes structural adjustments on growth equilibria, where fragmented channels undermine efficiency and heighten volatility transmissions. Intelligence assessments must prioritize monitoring purchaser compositions, settlement volumes, and liquidity indicators, as these elements delineate trajectories in contested financial domains with potential to redefine sovereignty parameters in interconnected global systems. The evolving dynamics, while gradual, amplify risks of asynchronous responses that perpetuate instability cycles, necessitating vigilant recalibrations to navigate emergent multipolar realities. In the context of an increasingly contested global financial order as of December 26, 2025, the acceleration of central bank gold accumulation, particularly among BRICS nations whose collective holdings surpass 6,000 tons, is fostering emerging multipolar reserve dynamics that incrementally erode dollar dominance while empowering the proliferation of alternative payment mechanisms designed to circumvent traditional dollar-centric infrastructures. This phenomenon, marked by sustained net purchases in 2025 totaling approximately 687 tons through October, with Q3 netting 220 tons and October adding 53 tons, represents a strategic response to heightened geopolitical frictions and macroeconomic uncertainties, enabling participating institutions to enhance reserve resilience against sanctions vulnerabilities and fiat currency volatilities. BRICS members, including Russia at approximately 2,336 tons, China near 2,298 tons, India around 880 tons, and Brazil at 145 tons following recent additions, command a substantial portion of official gold stocks, facilitating coordinated efforts to advance non-dollar commodity settlements that have gained traction in energy and metals trades. These settlements, increasingly invoiced in local currencies or through bilateral arrangements, reduce dependency on dollar clearing systems and insulate intra-block flows, valued in excess of significant bilateral volumes, from extraterritorial disruptions, aligning with geopolitical imperatives to mitigate risks observed in prior asset immobilizations. Economically, this multipolar transition elevates U.S. funding premiums by contributing to subdued foreign appetite for treasuries, where total holdings hovered around $9.243 trillion in October 2025 amid selective retreats, necessitating greater domestic absorption of issuance that strains auction clearance and embeds persistent term premiums in benchmark yields despite accommodative monetary stances. Market caution manifests in diversified hedging, with pronounced inflows into gold-backed instruments, ETFs capturing billions quarterly, and forward positioning that sustains structural support for commodity prices amid elevated valuations. Concealed perils encompass fragmented liquidity channels that amplify volatility in emerging markets, where reallocations toward gold exacerbate currency pressures and heighten rollover risks for extensive dollar-denominated obligations. Banking mismatches from these asset shifts trigger credit constraints, as institutions recalibrate collateral frameworks amid fluctuating valuations, potentially contracting lending in interconnected segments. Inflationary pass-throughs from commodity premiums further constrain global demand, transmitting elevated input costs through supply chains and dampening growth in import-reliant economies. This evolving order risks precipitating crises in interconnected systems through abrupt shifts that undermine entrenched stability mechanisms, where non-dollar mechanisms gaining operational traction impose fiscal drag on traditional issuers and perpetuate volatility cycles. The multipolar emergence, while measured, catalyzes broader realignments in trade architectures, elevating frictions and fostering bifurcated flows that challenge coordination efficacy. As reserve configurations incorporate greater neutral asset weights, the dynamics heighten systemic vulnerabilities, necessitating vigilant monitoring of purchaser compositions and settlement volumes to navigate potential asymmetries in demand sustainability and liquidity provision.